Hello friends, welcome to this session. So we started with the chapter of money and we have taken 2 sessions on that. This is the third session. So what will be the coverage of this session? Let us see. We have already seen the barter system, functions of money, money demand. So we have seen the different motives behind the demand of money. We have seen the money supply, quantity theory, we will see the money supply, quantity theory of demand we will see, sectorization of economy we will see, monetary aggregates we will see, liquidity aggregates and the relevant previous year questions, right? So these two, they were covered in lesson 1. Money demand, it was covered in lesson 2, and now all these aspects will be covered in the lesson number 3, which is the present session. So let us start with money supply. What is the meaning of money supply? So can you think and take 10 seconds? So friends, money and supply, right? So supply of money. Now what is money? Money we have already discussed, and here we will talk about the money in circulation. Money in circulation, and lying with whom? Supply is lying with whom? With the public. Public, which can include the household, the firms, and other institutions, including the government, right? However, this public does not include the banks, both the central bank and commercial bank. Central bank means the Reserve Bank of India. Commercial bank means the other banks like State Bank of India, Punjab National Bank, etc. So we do not include the money lying with these because they are the money producer or money creator, right? And they are the users of money. So the money is supplied from the money creator to the money user, right? So money is supplied from the money creator to the money users, right? So we will talk about the money which is with the public, right? And this money we will talk about is at a point of time, right? At a point of time is different from during a period of time. So at a point of time means on 31st March of every year, or it may be on 30th September of every year. So 31st March or 30th September is one point of time, is a particular point of time. It is not reflecting the duration. When I say the money supply between 31st March to 30th September, that means during 31st March to 30th September. That is a duration. But I am not talking about that. I am talking about as on 31st March or as on 30th September or any other date. You take any date. So one particular point of time has to be there. So definition of money, it refers to the amount of money which is in circulation in an economy at any given time. It plays a crucial role in determination of price level, right? So how does it play the important role in price level? So we have already studied in the chapter of inflation that when there is more money, that means the purchasing power of the individuals increase, and when their purchasing power increase, they demand more products. The demand increases, but the supply do not increase correspondingly. The supply takes time to increase. It takes time for the supply to increase, right? So supply do not increase. So demand is high, but supplies remain same. Consequently, the price rise, or this is also called as the inflation, right? So money supply plays a very important role in determining the rate of inflation in the economy. Similarly, interest rate. So interest rate is nothing but the cost of money. It is the cost of money. So if I want 1 lakh rupees, I have to pay certain interest amount to the bank. So that interest is nothing but the cost of money which I have taken from the bank, right? So this interest rate, now what is the relationship between the money supply and the interest rate? So if money supply is high, then interest rate should be less or more. So interest rate should be less, right? Why? Because if something is excessive in supply, definitely the price of that particular commodity will be less. So if money is in supply, money is in extra supply, that means the cost of money will also come down. And what is cost of money? Cost of money is nothing but the interest rate. So the interest rate will also come down, right? So with the increase in money supply, the interest rate come down, and vice versa, right? And vice versa. So this money supply has a direct relationship with the inflation and an inverse relationship with the interest rate, right? Growth of money supply helps in acceleration of economic development and price stability. Definitely. So if we have good money supply, that means the businessman can get money for investment. If they get money for the investment, that creates jobs. If jobs are created, the people have more income. When they have more income, they spend more. When they spend more, then the demand of the goods is increased, and the GDP is increased, and ultimately the growth happens, right? So the money supply actually helps in economic growth and economic development. When there is economic growth, that means the resources have been generated. Then we can distribute those resources equally among different sections of society, which is called economic development. So when these resources are when these resources are distributed among the individuals, they can increase their quality of life. They can buy the different goods and services like education, health. They can build their house. So their standard of living increases. So can you see that money supply plays very, very important role in the quality of life of the people. Similarly, price stability that we have already seen above. There must be controlled expansion of money supply. Definitely, controlled means neither too high, neither too low. If it is too high, then price stability will be disturbed, right? So there should be no inflation and deflation in the economy. As a concept, money supply is the total stock of money, right? So it is a stock concept. That means at a particular point of time, right? So we are talking about the stock concept. So in the economy, there are two concepts. One is the stock concept, another is the flow concept. So stock means when we measure anything at one point of time. So this point of time, as I already told you, can be any particular date, 31st March, 30th September, 31st December, right? Any particular date. Flow means during a period. During a period means between two dates. So between 31st March and 30th September. I am not saying on 31st March. I am saying between 31st March and 30th September. So this flow concept is different from the stock concept. This money supply is the stock concept. We calculate this as the total amount of supply on a particular date, right? So this is a stock concept. This question can be asked in the examination. They can ask whether the money supply is a stock concept or it is a flow concept, right? So this is about this. Now it includes money held by the public, very, very crucial, and in circulation, right? So the money which the public is having, right? The citizens, households, firms, etc., and the money in circulation, right? And does not include money held by central bank or the commercial bank, because they are the money creating agencies. Separation of producers of money from the users of money is important from the viewpoint of both monetary theory and the policy, right? Now this money supply has two elements. There are two elements. One is the currency with the public, and another is the demand deposits with the public. And this is also called, this is the money of public lying with the banks, right? So first is the currency with the public. This is also called as high powered money. So it includes notes and it includes coins, right? So if I say the currency with the public, that means either they can have the paper or they can have the coins. So both the paper and coins are there, right? So the coins, they can be issued by they are mostly issued by the central government, right? So coins and small coins both. So and rupee notes also, right? So whether the currency is issued by the RBI or this is issued by the central government, both of them are covered in the currency with the public. Now demand deposits with the public, that means the deposit of the public with the banks, or this is also called as the bank money. And friends, I already discussed in the previous session that the deposits can be of two types. One is the demand deposit, another is the time deposit. So here we are talking about the demand deposit. Here I am not talking about the time deposit. So demand deposit, what is the meaning of demand deposit? Means which can be withdrawn at any time. That means any individual can go to the bank and can demand the money back, right? So the customer or the depositor can withdraw this money at any time. There is no minimum number of months, days for which he or she has to wait before withdrawing the money. That is the main thing. So before we move ahead, let us see the sectorization of economy for the purpose of calculation of the money supply. So for the purpose of compilation of monetary and liquidity aggregates. Now what is monetary and liquidity aggregates? So we just discussed the concept of money supply that we are calculating at one point of time. Now what are the measures through which we calculate these monetary and liquidity aggregates? So the measures or the indicators of the money supply are called the monetary and the liquidity aggregates. So in the session, as we move ahead, we will discuss monetary aggregates and also the liquidity aggregates. So RBI has sectorized the economy in 6 sectors. So what are those 6 sectors? A, household; B. RBI. C. Banking system in India. D. Other financial corporations. E. General government. F. Non-financial commercial sector. So households, what is the meaning of household? Means a group of individuals who can take the economic decision. RBI means the central bank. Banking systems in India. So all the commercial banks. Other financial corporation means the financial institutions. General government, which includes state government, central government and the lower government. Non-financial commercial sector. So these include other institutions which are not the financial institutions. Now, when we combine B and C, that means RBI and the banking system in India. So, when we combine the RBI and the banking system, we get banking sector. So, banking sector means the Reserve Bank of India plus the banking systems in India. Next, B plus C plus D. B plus C plus D means the RBI plus banking systems plus other financial corporations. All these three combinedly are called financial corporation sector. Right? So banking sector is one of the component of financial corporations sector. Now, B and C, that means RBI and banking sector, or the RBI and the banking system, or the banking sector, this one, they are the money issuing sector. So they are the suppliers or the creators of money. And A plus D plus F means the households, the other financial corporations and non-financial commercial sector. When we combine all three, it is nothing but money holding sector or the users of money. Right? So who supplies? The banks and the central bank. Who uses? Households, other financial corporations and non-financial commercial sector. Non-financial commercial sector means like industry. Sorry. Yeah. So non-financial commercial sector means industry, etc. Right? Now, this is the domestic categorization. Now, this domestic categorization is impacted by the money which is circulated with the rest of the world. So this is the rest of the world. This is rest of the world means other countries of the world apart from our country. So we are getting FCNRB means foreign currency non-resident bank account. That means the non-residents, they have opened a bank account in India's bank in which they are depositing the foreign currency. So Mr. Ram, who is working outside India, he is opening account in the State Bank of India in the New Delhi branch, and he deposits the dollar currency. So such account is called foreign currency non-resident bank account. Right? So don't get confused. It is very simple. RIB's Resurgent India Bonds is a special scheme of SBI to raise funds from abroad. So friends, now you may ask, sir, do I need to remember all these 6 A, B, C, D, E, F? No, friends, you are not supposed to remember these 6 categories. You just have an idea that there are 2 major categories. One is the money creator, another are the money users. And that banking sector means RBI and the commercial banks, both. So you should have a broad idea so that when you are reading the newspaper or the economic survey, you are not confused. But I am sure in the examination they are not going to ask such type of question. They have much better questions to ask. So this particular topic might look like very conceptual, but actually this is one of the very simplest thing, and nothing very significant about this. So don't worry, you don't need to learn by heart this categorization. Now moving ahead, this money supply, the constituents of the money supply. So the constituents of the money supply, they are having two categories. One is the traditional approach, another is the modern approach. So if we see traditionally, in the traditional manner, the money was restricted to a very narrow level. That means the money which we can see and the money which we are having directly in our hands. That means that includes coins, currency, demand deposits. So only this kind of money was considered to be the money supply. But now in the recent time we can see there are a lot of new options coming up. You can see credit money is coming, electronic money is coming, a lot of other long-term deposits we are making apart from the demand deposits. We have checks, we have NEFT. So we have whole lot of new spectrum of these money supply instruments. So we are including not only the traditional money but also the near money. Now, how do we measure the money supply? How do we measure the money supply? So I told you that we have some measures of the money supply which are called the monetary aggregates. Right? So this money supply, this can be calculated at 4 levels. Right? So money supply starts from the money monetary base or the M0. So this is the starting point. This M0 or monetary base, it means the high powered money. And do you remember what is the meaning of high powered money? So we already discussed in the previous session when we discussed about the role of RBI as the currency issuer authority, right? So that was monetary base, and we will again discuss. After that we have M1, then we have M2, then we have M3, and finally we have M4. So this M0, this is having the least quantity and highest liquidity. Now what is the meaning of liquidity? You can ask. Liquidity means the easiness with which anything can be converted into cash. I have already discussed this concept, right? So MO or MB, it is having the least quantity but highest liquidity, and this quantity increases as we move to the M4. So M4 is having the highest quantity, and M0, which is having the highest liquidity, as we move to the M4, it is having the least liquidity, right? So why highest quantity, why highest liquidity? You will come to know when we discuss each one of these items. So now let us see, starting with the M0. M0 is called reserve money also, because this is the money which is the original base. So who is the original issuer of the money? The original issuer of the money is the Reserve Bank of India. So RBI issues the money, right? So this money which is issued by the RBI, this is called reserve money, right? This is called reserve money. This is also called as the monetary base. This is also called as the monetary base, because based upon this only any other money supply measure is created. So let us see. So we already discussed the role of RBI as the currency authority, And at the time I told you that this is basically the high powered money or the M0 or the reserve currency. So it includes the total currency notes and the coins of rupee 1. So it includes not only the RBI issued currency but also the currency issued by the government. So it consists of the money held by the public, money held by the other banks, right? So the banks other than the RBI, they are having some money for their day-to-day operations, and the other deposits which are lying with the RBI. The other deposits which are lying with the RBI. What are these other deposits? I will discuss in the next slide. So M0 reserve money is equal to the currency in circulation plus. So currency in circulation includes both the coins issued by the government and the currency issued by the RBI, right? Bankers deposits with the RBI. So bankers deposit with the RBI. So what kind of deposit they make? So bankers actually deposit some money as the cash reserve ratio. What is this cash reserve ratio? So cash reserve ratio is basically a certain percentage of the deposit which the bank have from the customer. That certain percentage is deposited with the RBI. So suppose bank get 100 rupees from the customer. Out of 100 rupees, 4 rupees will be deposited with the RBI, so that at the time of any emergency, RBI can support the banking system, right? So this is CRR. We will discuss CRR in detail in the coming sessions in the banking sector only. So banking deposits, which include the CRR and the excess reserve. What is excess reserve? Excess reserve means there are some banks who can deposit extra money apart from the CRR with the RBI. So that is also included here. Other deposits with the RBI, it has a long list. So I will cover this in the next slide. Now, coming back to the currency in circulation. So currency in circulation is the total amount of rupee notes issued by the RBI. So that means this rupee currency and the rupee coins and small paisa coins issued by the government of India. So this one, right? Bankers deposit with the RBI, it includes CRR and the excess reserve. So these two things I already told you here. Now, what are other deposits with the RBI? So other deposits include the deposits of the quasi-government and other financial institutions. So what is quasi-government? Quasi-government are the semi-government institutions or semi-government agencies which are not part of the general government like state government, local government, but are owned partially by the government, right? So deposits of the quasi-government and other financial institutions, including the primary dealers, right? So financial institutions which are quasi-government means partially owned by the government, or the other financial institutions including the primary dealers. What is the meaning of primary dealer? Primary dealers are the financial intermediaries. They are kind of brokers which are operating in the government securities or GSECs and other financial instruments. So primarily they are operating in the GSECs. So the financial intermediary who are operating in the government securities, they are called primary dealers. So in the examination you can find this term. They can ask what is the meaning of primary dealer. So at that point of time you should know that primary dealers are basically the financial intermediaries who operate in the government securities. It also includes balances in the accounts of foreign central banks and the governments, accounts of international agencies such as IMF, etc., provident, gratuity and guarantee funds of RBI staff. Friends, I am telling you, in the UPSC, they will not ask the constituents of the other deposits with the RBI. So why still I am telling you? Because I want that you don't go anywhere apart from this classes and the lectures. Because if I don't cover these things here, you will think that Rahul sir has not covered these things. So I am covering this particular slide for the sake of coverage, but I am telling you, they will never ask such a can be silly question or irrelevant question, because they don't want to make you learn too much facts. They want your conceptual clarity, that you should understand the basic mechanism how this economy operates, the basic mechanism how the different economic transactions are happening. They don't want you to become the economist, they want you to become the administrator, right? So you should know how the banking sector operates, you should know how the central bank operates, you should know how the central government operates, but each and every small transaction is not that much important unless and until it is in the current affairs. So had it been in the news, in the current affairs, I would have surely shared that please remember these things by heart, right? So you might ask, sir, we call M0 as the reserve money, but why? So we call it reserve money because this is money which is held by the public, right, or held by the RBI, but not available for lending, right? So this money is not available for lending. That is why we call this money as the reserve money. So this money is actually reserved money which is put in vault or as safe. Now M1. So M1 is a little bit more broader than the M0, right? So what is M1? It includes those items which can be spent immediately or readily accepted as a medium of exchange. So the items which can be spent immediately, right? Or the amount, the money which is very near to cash. So it is high, the main thing is that it is high in liquidity, right? So this money can be spent directly. So it includes cash, current accounts, etc. So what are the different elements of the M1? Different elements of the M1 includes, M1 is equal to currency with the public. The first aspect is, it is the currency with the public, right? Then demand deposits with the public in the commercial and cooperative banks. Third, other deposits held by the public with the RBI. So you can see we are talking about demand deposits here. We are not talking about the time deposit, because the time deposits are not possible to draw against check immediately. So because time deposits are not liquid, that is why we are not including the time deposits here. Now let us see each one of the constituents of the M1. And friends, let me tell you, M1 is also called as the narrow money. So the first aspect was currency with the public. So currency with the public means the currency in circulation minus the cash on hand with the banking system, right? So currency in circulation is basically a total of the money with the public and the money with the bank. And when we eliminate the money with the bank, that means the currency with the public is derived. So currency with the public means the total money in circulation minus the cash on hand with the banking system. Then demand deposits. So what are the demand deposits? Demand deposit means that part of the deposit which can be withdrawn immediately, right? These demand deposit, they can be of two types. It can include the current deposits, or they are also called as the current bank account. So normally the businessmen are allowed to open the current bank account. They can withdraw any amount of money in their bank account, and they can withdraw any amount of money from that bank account, right? So demand deposits, it includes two major types: the current deposits and the saving deposits. Current deposits and the saving deposits. So current deposit, current bank account; saving deposit means saving bank account. Now these saving deposits also, this saving deposit also have two kind of account. One is the account with the demand liability, means those account where the money can be withdrawn immediately, and another is the amount with the time liability, means where the money cannot be withdrawn immediately. So in M1 only the demand liability portion is included, right? So this only and only demand liability portion is included in the M1. So can we rewrite the equation of the previous slide like this? So M1 is equal to the currency with the public, this one, plus the current deposits with the banking system, like this one. The demand liabilities portion of the saving deposit with the banking system. So that means this portion and other deposits with the RBI that we already discussed previously, right? So this is what we mean by the M1. So you have seen M1 very clearly now. Now coming to the M2 and M3. So M2 means a little bit less liquid than M1, right? So here we include saving deposits with the post office saving account banks. So our post office are also having the saving accounts. So the money which is deposited over there, that money is little bit less liquid than the demand deposit. So these small saving deposits, they are not as liquid as the demand deposits, but are more liquid than the time deposit, right? So we are including the saving deposit with the post office saving bank account in the M2. Coming to the M3, so M3 is also called as the broad money. So in the broad money, we include the time deposit also, right? So time deposit we did not include in the M2, but we are including in the M3. So time deposit with the banks are not as liquid. However, so you might ask, sir, time deposit is not withdrawable. So why are you including in the M3? They cannot be withdrawn. Normally, time deposit means the fixed deposits that we have made with the bank, and those fixed deposit will actually be withdrawable after the maturity period is over. So if we have made the FD for 5 years, we cannot generally withdraw that money before the expiry of those 5 years. Are you getting the point? So we cannot withdraw the money from the FD, but still why we are including in the M3? We are including the M3 because although we cannot withdraw the amount of money from the FD, but we can take the loan against that FD, right? So although we cannot withdraw the money from the FD, but we can take the loan against that FD. The bank can give the loan against its own FD. So this FD works as a security for the bank, right? So that is why we are including this time deposit in the M3 or the broad money. M4. M4 includes M3, right? So M3 means up to the time deposit portion plus the total post office deposits. So here we are including all savings and time deposits of the post office also, right? So here we are including everything. So friends, I know that with this much of information, you might be feeling a little bit confused. So I will make you revise this particular measures. So coming to the M0, M0 means high powered money or monetary base or base money. It includes the currency in circulation plus the bankers deposit with the RBI plus the other deposits with the RBI. Currency in circulation, it includes both the currency with the public and the money with the banks. Bankers deposit with the RBI, this includes CRR plus the excess reserves. So friends, I will recommend that you have your notebook with you when you are watching the lecture. Don't rely on the printed notes. Friends, make your own notes. There are a lot of things that I will tell you during the session only. Not everything can be given in the written form. So make your own notes, make the summaries, because in the examination time those summary will actually help you a lot, right? So I will provide you the crux notes, but still those crux notes cannot be the replacement to your own notes. Your own notes are like yours. It is your asset. And why I am saying that? Because when you read your own handwriting, you are able to connect with that handwriting. Your grasping power is increased. So you are very comfortable when you are reading the notes of your own handwriting, and it takes very less time in the just before the examination to revise all those notes. So I will always recommend that when you are watching the lecture, don't watch this lecture as the TV serial, right? This is not the TV serial. This is not the news channel. This is a lecture, dear. This is a lecture, and you have to be 100% attentive in the lecture. You cannot be sitting in your bed. You cannot be sitting in some casual place. You cannot be lying down in your place. You cannot be lying like that, right? You have to be straight, attentive, so that every bit of the lecture gets into your memory. And friends, still you cannot retain all the lecture. For retention of the lecture, you need to revise it again and again and again and again. So you may have to revise it 10 times from your own notes. And friends, don't think that for every revision you have to go back to the lecture and see it, because dependence on the lecture is not a good thing. You can see the lecture 1 time or 2 times, but going to the lecture for 5 times is not recommended. Use your own mind. Try to cover concepts from the lecture, from the session, from the videos, from the classes, only maximum 2 times. 3rd time you should not ordinarily see that, unless and until you are actually confused, unless and until you are not able to understand that concept in detail. So I am really concerned if you are not taking the lecture seriously. I am really concerned if you are not revising the lecture seriously. Friends, I will recommend that you should revise the lecture immediately on the next day and within a week. So if today is Sunday, you should revise the lecture on Monday and the next Monday also. So this scientific thing actually helps a lot. This is a science. Nothing special with you or me. We don't have extraordinary memory. We are not the robots. We are the individuals. We are the human beings, and we have our own loss of memory. So my request is that please note down in your handwriting. Don't be dependent on the printed notes. The printed notes will be printed only. But when you write them down, you are actually grasping every bit of the concept, and that makes a lot of difference in the examination hall. I know most of the qualified candidates, they have their handwritten notes. Even if they might refer to multiple books, but they make their own notes, so that at the examination time, in the revision time, they are not confused. They are crystal clear about the concepts. So coming back, M1 includes the currency with the public. What is currency with the public? Currency with the public means currency in circulation minus the currency lying with the banks plus demand deposit with the banking system, which includes the current account and the demand liability portion of the saving account plus other deposit with the RBI. M2 means M1 plus saving deposit of the post office, saving bank. M2 means broad money, M3. M3 means broad money, which includes M1 plus time deposit with the banking system. And finally, we have the M3 plus all deposit of the post office, which is the M4. So M0 is reserve money, M1 and M2 are the narrow money, and M3 and M4 are the broad money. Now, liquidity. Which one is more liquid? So when I started talking about these measures, at that point of time only I told you which one is liquid, right? But still, let me tell you again. So M1 is more liquid than M2, M2 is more liquid than M3, and M3 is more liquid than M4. So M1 is highest liquid and M4 is the least liquid. So M1 is most liquid and M4 is least liquid. Friends, there can be a question on this part. quantity wise, M1 is having the least quantity because we are excluding a lot of items. So M1 is having the least quantity and M4 is having the highest quantity. Right? Now, UPSC previous year question. You should be happy because whatever we are studying, we can see that UPSC asks the question on that part. It is not that UPSC don't ask the question from here. UPSC asks the question from here. So be happy that whatever you are studying is actually relevant in the examination hall. The first question, consider the following. Statement number 1, currency with the public. Statement number 2, demand deposits with the banks. And statement number 3, time deposit with the bank. Which of these are included in the broad money in India? So the question is about the broad money. So tell me, currency with the public, yes or no? Yes. Demand deposit with the public bank, yes or no? Yes. Time deposit with the bank, yes or no? Yes, very clearly yes. So broad money means it includes all these 3 items. So option A, 1 and 2, this is incorrect. Option B, 1 and 3, this is incorrect. Option C, 2 and 3, this is also incorrect. And option D, that is 1, 2 and 3, this is the correct answer. So the answer is very, very easy, but only if you understand the concept clearly. Next question from the same topic. The sum of which of the following constitutes broad money? So this broad money has been the favorite area of the UPSC in the era of 2000s, right? Statement 1, currency with the public. Statement 2, demand deposits with the banks. Statement 3, time deposit with the bank. So these 3 items we already saw in the previous question also. So can you see the UPSC repeats its own questions? Yes, not directly but indirectly. So if you are covering the previous questions, rest assured you will be benefited, right? Other deposits with the RBI, yes, that is also part of the broad money. So choose the correct answer. This question was asked in 1997 and this was repeated in 2002. We just saw the previous question. Option A, 1 and 2. Option B, 1, 2 and 3. Option C, 1, 2, 3 and 4. And option D, 1, 2 and 4. What is the answer? Answer is option C, 1, 2, 3 and 4. Be happy. New monetary aggregates. So the concepts that we have discussed are there. At the same time, one more set of monetary aggregates is published nowadays. So this new set has been published after 1999 after the recommendation of the third working group, right? So the new monetary aggregates include M0 monetary base, NM1 narrow money, NM3, NM2 intermediate money, NM3 the broad money, right? And they are based upon the residency concept, right? And in the new series, they are clearly distinguishing between the monetary aggregates and the liquidity aggregates. So in the new series, now they are also talking about the liquidity aggregates. What is new series? So new series is much more complex than the older series, right? But the good thing is that the concept is not much different. So rest assured, you don't need to learn by heart each of these lines. You just need to understand the concept, right? NM1 currency with the public plus demand liabilities portion of saving deposits with the banking system. So it is very much similar to the old M1, excluding only 2 items, the other deposits with the RBI and the current account, right? NM2 is equal to NM1 plus time liabilities portion of saving deposit with the banking system. So in the NM2, they are including the time liabilities, certificate of deposits issued by the banks. Certificate of deposits issued by the banks. So certificate of deposit is a money market instrument which are issued by the bank having a large amount of money. Like the amount is very high. They are issued as the money market instrument. plus term deposits of residents with a contractual maturity of up to and including 1 year with the banking system, right? Excluding certificate of deposits. So this term deposit of our resident with a contractual maturity up to and including 1 year. So that means the fixed deposit up to 1 year, right? NM3, it includes NM2 plus long-term deposits of residents, right? Long-term deposit, right? Plus call or term funding from the financial institutions, or this is all this, we can also say NM2 plus term deposit of resident with a contractual maturity of over 1 year. So up to 1 year we include in the NM2, over 1 year we are including in the NM3, sorry. Plus call or term borrowing from non-depository financial corporation by the banking system. Friends, many of these terms like call borrowing, term borrowing, this certificate of deposit, I will discuss at the time of money market instrument. You just need to remember that from NM1 to NM3, the liquidity decreases and quantity increases. The relationship remains same. And friends, if you remember the concept of M0, M1, M2, M3, M4 that we just discussed, that is much more beneficial. Now, this new series, let me tell you some facts about it. So, NM1, it includes only non-interest bearing asset monetary liabilities. So, for example, the demand liability portion of the saving account, that is basically non-interest bearing asset. NM3, on the other hand, is an all-encompassing measure that includes long-term deposits, right? So NM3 is very broad, right? NM4 has been abolished, so there is no M4 in the new series. And NM2 is an intermediary that stands in between the narrow money of NM1 and the broad money of the NM3. So NM1 is the narrow money, NM2 is the intermediate money, NM3 is the broad money, and there is nothing called M4. M4 is not there, and M0 is already there because this is nothing but the monetary base, and this will always be there, right? So this is the new series of the monetary aggregates. Now, this table I have taken from the economic survey, and you can see economic survey, how does it represent the year-on-year growth in the monetary aggregates. So in the volume 2 of economic survey, you will find this in the chapter of financial intermediaries or the banks. Here you can see currency in circulation, cash with bank, currency with the public, right? And bankers deposit with the RBI, demand deposit, time deposit, everything. All these figures you can see over here, right? So all the figures are calculated. Reserve money, narrow money, and broad money. So you can see all of them are being published. And friends, you don't need to remember how much is the figure. I am just showing you so that you can actually understand the economic survey is also dependent upon these fundamentals only. Now, liquidity aggregates, right? So the monetary aggregates were talking about the money supply. The liquidity aggregates will talk about the liquidity in the system. We want to calculate the liquidity in the system. So for that, we will take the liquidity. So if we talk about liquidity, they have been calculated since the third working group of the RBI. So since they recommended, they have been calculated, right? So liquidity aggregates includes the more number of financial assets than what is included in the monetary aggregates. So liquidity aggregates are much more broader. Now what does this liquidity aggregates refer to, or what does it cover, right? So it relates to the liabilities of, right? It relates to the liabilities of the RBI or the central bank, depository corporations or the banks select non-depository corporations, like development financial companies, like so DFIs. So maybe it can include your ICICI, not ICICI Bank, but the ICICI as the financial institution, right? So it includes RBI, it includes depository corporation. Third, it includes select non-depository corporations, and fourth, it includes NBFCs accepting the deposits from the public, right? So NBFCs which are accepting the deposits from the public, we are including these. So can we see over here the spectrum of coverage is much more bigger. We are talking about the liabilities of all these. In the monetary supply, we were talking about primarily about the RBI and the depository corporation. So there we were concerned about these two. They were considered to be the money suppliers, and we were talking about the liquidity of these two institutions. But now we are also expanding to these two because they are also part of the liquidity of the system, and we want to check the liquidity of the system. Then we should actually choose this. So it includes more number of financial assets than the monetary aggregates. This statement can be asked in the examination also. Please remember this. Again, liquidity aggregates. So liquidity aggregates, L1 is equal to M3 plus all deposits of post office savings banks excluding the national savings certificate. So national savings certificate is a money market instrument. I will tell you. It is a kind of saving. It is a saving instrument. L2 is equal to L1 plus term deposit with the term lending institutions, right? The institutions which lend for the long period of time, plus the refinancing institutions. Refinancing means the institutions which finance those institutions who are giving the loan, right? So they are refinancing or financing those institutions who finance the others, right? Plus certificate of deposits issued by the FIs. L3 is equal to L2 plus public deposits of the NBFCs. Now, determinants of money supply, right? So money supply we have already discussed. How do we determine the money supply? So there are two determinants of the money supply. One is the reserve money or high powered money. Reserve money or the high powered money. So this is the base. And this base gets multiplied by the size of multiplier, and that is how we get the value of the money supply. So this M0 is multiplied by the money supplier. Multiplied by the money multiplier, and that is how we get to know how much is the money supply, right? So now you can ask, sir, what is money multiplier? What is money multiplier? So this money multiplier is coming from the concept of fractional banking. What is fractional banking? So fractional banking is a concept which says that the banks accept the deposit. When they accept the deposit, suppose they accept 100 rupees of deposit, they will have to reserve certain percentage of that deposit and keep that reserve with themselves or with the RBI. So suppose they keep 30% of the deposit either with themselves or with the RBI. So they can lend rest 70% to the customer again, right? So keeping certain amount with them as reserve and lending rest of the amount, that means the same 100 rupees they can be given as a loan multiple number of times. So this concept increases the supply of money in the market multiple times. So the same 100 rupees will be circulating in the accounts of different customers, will be reflecting as the bank balance of different customer because of this phenomena. And this phenomena leads to the money multiplier, right? So I will discuss this phenomena in the next session in detail. What is the origin of this fractional banking? So the origin belongs to the ancient times, and more importantly, this concept became more famous after the Great Depression of 1932. And right now we have this system, and because of this, the money supply is actually happening at a very big level. So there is money creation which is happening through the bank only with the system of the fractional banking. and there are monetary policy tools which try to control the money supply by impacting this fractional banking only, right? So we will discuss about the fractional banking in detail, but as of now you just understand that money multiplier basically is reflecting the relationship between the monetary base, that is the M0, and the money supply, that is the M3. So it is a ratio between the borrowed money and the reserve money. So M3 upon M0, right? M3 upon M0. Or if we want to calculate, how do we calculate the money multiplier? So it means M3 will get multiplied by 1 upon M0 times. So M3 will get multiplied by, so M3 upon M0, or can we say M3 multiplied by 1 upon M0? This is one and the same thing mathematically, right? So if the reserve money is 20%, right, that means this M0 is 20%. So if this is 20, then MB is equal to 1 upon M0, that is the 5. So 1 upon 20 multiplied by 100, that comes 20. So M3 will get multiplied 5 times in the economy. So it means money supply will increase 5 times, right? So reserve money has an inverse relationship with the rate of reserve money has an inverse relationship with the money supply. If reserve money is 20%, then money supply will be 5. Now, what are the different factors which determine the money supply? So it depends upon the monetary base, because base means the foundation. If the foundation is less, then less money supply. So if the quantity of stock gold, reserve assets, central bank outstanding, that is the monetary base, when this is less, that means the money supply will be less, because this is the foundation. Then bank credit to the government, whether the bank is giving credit to the government, because the government can further expand it. If the bank is not giving credit to the government, then the government cannot expand it. Bank credit to the commercial or private sector, that also depends. If the bank is easily giving, then there will be more money supply. If the banks stop giving, for example, in the recent couple of years, the banks have actually reduced the lending because of the NPA, non-performing asset crisis. Community choice. So before 2016, people used to have more money as cash. So when more money is kept as cash, that does not become part of the money supply. So credit creation is actually stopped. That is a part of money supply, but the credit creation by the bank through the system of fractional banking, that is not possible. If they are using the check, then it is good. It increases the money supply. Changes in net foreign exchange assets. So if the foreign exchange reserves are increasing, that means more money supply. Government currency liabilities to the public and velocity of circulation. What is velocity of circulation? Let us see. Velocity. To find out the supply of money over a period of time, we have to consider the velocity of circulation of money. It is the average number of time the money circulates from the one hand to the another, right? So if I have rupees 50 note in my pocket, I give this 50 rupees note to the rickshaw wala. He gives this rickshaw wala, give this money to the restaurant person. This restaurant person gives this money to the supplier of grocery. And the supplier of grocery, he gives this money to the farmer. And all these transactions, it is quite possible, can happen in a single day, right? So this 50 rupees note has exchanged the head 1 time, 2 time, 3 time, 4 time. So can you see that this 50 rupees has actually become 200 rupees. It is acting as a total 200 rupees. So this is possible because the velocity is 4 times. This 50 rupees is circulating 4 times. So money supply is actually impacted. If this is not possible in a single day, then money supply will be restricted to 50 rupees, right? So supply of money during a given period is equal to the time of money circulation multiplied by the average number of time it has changed during that period. Factors affecting the velocity of circulation. First, the time unit of income receipts. So, it is possible that there are two options. In the first option, the money or the salary is received on the first day of every month, right? And in the second option, it is received on a daily basis. For example, the daily wage workers. In both the cases, the money supply will be different, right? So if the salary is received on the first day, then the velocity will be high in the initial time, and later it will be less. Then method and habit of payment. If the people are making the payment through cash, or are they making through the check? If they are making through the cash, then velocity will be less, because the cash will not be able to travel to a long time, to a multiple number of people. But the check or the bank money, it can travel very fast. Degree of regularity of income receipt. Distribution of national income. Is the distribution skewed to the limited number of people, or it is well distributed? If it is well distributed, then there will be more velocity. Business conditions. If the business conditions are good, there will be more velocity. Development of banking sector. If the banking sector is well developed, there will be more velocity. Speed in transportation of money. If the transportation is very quick, then there will be more velocity. And liquidity preference function. Whether the people are preferring to the liquidity or not, that also impacts. Next is the quantity theory of money. Quantity theory of money establishes a direct relationship between the quantity of money and the prices. So in the starting itself, I discussed that more is the money supply, more is the purchasing power of the people, more is the demand, and when there is more demand, that means the price is also rise, right? So if the amount of money in an economy doubles, the price level also doubles, causing the inflation. This is the simple quantity theory. With this, I complete this session, and in the next session, I will start with the monetary policy tool. I will start with the fractional banking, the flexible inflation targeting framework, monetary policy committee, and qualitative and quantitative monetary policy tools, which you will find very, very useful. So I really thank you for watching and completing this session. Again, friends, I will say, please make your own notes, revise these notes. There is no alternative to that. I am always available to help you. My email ID is writetobias.r@gmail.com. You are always welcome to send any query to me, and I will be more than happy to respond to you. Thank you very much. God bless you.